Ind AS 115 revenue from contract with customers. The objective of the standard to establish the principle that the entity shall apply to report useful information to the financial statement. So the standard is used to provide information to the users in a way its nature, amount, timing, and uncertainty of revenue and cash flow arising from the contract with the customers. So these contract are there. Then for that contract, which is what is the revenue you need to include? We need to say that is what this revenue contract is all about. The scope of it, the standard applies to all the contracts with customers. It is applied to all the contract customers, but it does not apply in the AS 116 leases, in the AS 104 insurance, in the AS 109 financial instrument and other contractual rights and obligation of the scope, in the AS 1110 financial instrument and Ind AS 1111 consolidated financial statement, Ind AS 27 joint agreement, and Ind AS 28 separate financial statement, and investment in associates and joint venture and non-monetary exchange between entities and same line of business to facilitate sale and customers to potential customers. So in these they are accepted. So because these are governed by separate NDAs, so that will follow. We can't supersede with this NDAs with other NDAs. That's what's been said. The core principle of Ind AS is that the entity recognizes revenue in the way that deposits the transfer of promised goods, promised service to customer. So recognize revenue. When the title is transferred, risk and reward is transferred, then we need to calculate the revenue. Amount that reflect the consideration in which entity expected to entitle in exchange of goods and service. So what is the amount that is required, that is to entitled by the user for doing such a service or providing such goods, that to be accounted as revenue. The revenue shall be recognized by the entity in accordance with the core principle applying five steps. Identify the contract with the customer. First, identify them. Identify their performance obligation control. How much performance they have conducted. The determination transaction price. What is the price agree upon? What is the stage of price if we can recover from it? Third, fourth, allocate the transaction price and the performance obligation in the contract. So, what is the transfer price? What is the performance obligation we have? And recognize the revenue from the entity satisfying performance obligation. Performance obligation. When the performance is satisfactory and the obligation is fulfilled, then the revenue can be recognized. This is the five stages to be counted. Identify the contract with customer. What is the contract? The standard defines contract and a customer a specific five mandatory criteria to meet the identification of the contract. So first you need to identify from this customer I am getting this revenue, and with that customer I have a contract for this stipulated period of time for a consideration of this much, an additional consideration this much. It has been agreed between the customer and agreed in this date. Such a way for the draft should be there, contract should be there. Second, identify the performance obligation in the contract. The contract indicates in the contract inception that asset has shall the entity shall assess the goods and service promised in the contract with the customer and shall identify the performance obligation of each of the promise to be transferred in the customer entity. So identify the performance obligation. What's the performance obligation? I want to construct this. I want to provide this service. I want to do this surgery. I want to build this software. Such a way, and something should be identifiable between the customer and should be mentioned in the contract. The goods and service is a bundle of goods and service that is distinct in other words. So it can be goods or it can be service, it can be both goods and service. The customer can benefit from the goods or service either on its own or together with its other resources that is readily available to the customer. So it can be already there to be delivered or to be developed or to be given both goods and service or separately. The entity promised to transfer the goods and service to the customer in separate identifiable form from other goods and service in the contract. Sometimes they need to transfer to the customer in a separate identifiable form. If that is contract inside, it is to be said. A series of distinct goods, a series of distinct service that is substantially the same, and that will be the same pattern of transfer to the customer. How will be transfer? A series of goods. This. Are you building a hundred pillars dam, 100 pillars flyover? So 100 pillars is going to be given, 100 pillar to be constructed, or both. Such a way kind of transfer should be the this is the kind of transfer it has happened, transfer is complete, so we should conclude it now. That's what. Determining the transaction price. The standard uses transaction price approach instead of fair value approach in Ind AS 18 while determining determining consideration. So for determining the consideration they are using transaction price, not the fair value price, as per the Ind AS 18. What is transaction price? What is fair value price? For this service, this is the fair value. For this contract, for this segment, this is the transaction value. That is a transaction price. If we separate it, this kind of thing is transaction price. A transaction price is the amount that consideration in which entity expect to be entitled in the exchange of transferring a promised goods or promising transferring a promised service to the customer, excluding amount collected on behalf of the third parties. Example, sales and tax. So say in this contract, if this part has been done, he will be paying you. I will be receiving this payment. This good should be transferred. So goods is transfer is identified, contract is identified. For this goods of the total contract, this is this much percentage of the goods. So I is entitled to this much revenue. That is the thing. The consideration promised by includes fixed amount, variable amount, or both. So consideration can be forced both fixed and variable amount or both. The consideration promised in the contract include variable amount. The entity shall estimate the amount of consideration in which entity will be entitled to exchange or transferring of promised goods or promised service to consumer. So if it is a fixed value, no issue, but it is a variable value, the computation will be there. As a contract will be taken into consideration. Proportion of the contract will be taken, everything will be put into field and there the file find the value. The variable consideration includes transaction price only to the extent that highly probable that significant reversal in the amount of cumulative revenue recognition will not occur when the uncertainty association with the variable consideration is subsequently resolved. This is in the case of fixed consideration, a variable consideration. Only thing is there is no kind of what is actually being done to be recognized. Example, in the building construction, so I've completed 70 percentage of the construction. 70% construction is completed. We should get a certificate. We can't say I have completed 70%, but actually been done only 40%. Nothing like that. Actually, what is completed, that is only should be taken. No such. We can first get the payment and then after we can book the profit, nothing like that. The estimate of variable consideration can be determined by using either expected value method or most likely amount method. So how to kind of find that expected value or most likely what is be proportion can get. Transaction price also adjusted in the effect of time value of money if the contract includes significant financial compound and any other consideration payable to customer. Sometimes they will consider time value of money. In the kind of 5 years construction, the price of goods may go up, the employee salary may go up. Then after that, maybe a revision in the contract. Then that is also to be considered. A sale and use based royalties arising from license of intellectual properties are excluded from the transaction price and recognition when the later is following events occurs. Sometimes we may get royalty. Example, want to construct this software. This software is owned by this company. We are buying that company's software. Now it has been asset has been transferred to us. Now we are using that for an application. Not only we using this for some application, it has already been used. It has been license been leased to some organization. We make it revenue from because transfer of property include transfer of royalty rights. Royalty rights we hold it. So any income that arising out of the royalty rights we can earn it. That is the thing. The subsequent sale and usage we may put a investment, but at the same time you'll make it income through royalties. The performance obligation is which sum all of the sale based usage based royalty has been allocated, been satisfied or partially satisfied. That how it is satisfied, how it is usually done, we should see. An allocated transaction price to allocate the transaction price to performance obligation in the contract. So transaction price to be allocated based upon the performance obligation, how much we have done, how much we need to do. Obligation is we need to do more. The entity typically allocates transaction price to each performance obligation on the basis of relative standalone selling price, standalone of each distinct goods and each routine service promised in the contract. They will the contract will break into different parts, and total contract price will be standalone basis on a standalone relative standalone basic selling price. It will be allocated. So completing this is the cost, this is the revenue, this is the cost, this is the revenue. So they will complete the total process and come, and then after they will derive it. This is what the standalone selling price is not observable. The entity estimated sometimes a transaction price include discount or a variable amount of consideration that relative entirely to part of the contract. Sometimes this also be the present value need to be considered, some variable cost to be considered, discount to be considered. Everything's also involved in the cost of valuation. The required specific when the entity allocates a discount or variable consideration to one or more, but all performance obligations of the contract. So whatever we do, we should based upon the performance obligation, the variable should the consideration to be considered. The subsequent changes in transaction price shall be allocated to the performance obligation on the same basis as a contract implication. If there is subsequent change in the valuation, what so we have done 45 percentage, but maximum 55% we need extra additional consideration of this much. So that should be based on the contractual inception. So first, this is also profit, but it's not a prior profit. But right now it has been contract is varied. It will be considered as an income in this current year. The amount allocated to satisfied performance obligation shall be recognized as a revenue as a reduction of revenue in the period in which transaction price changes. This is also gonna sometimes of completing this goods in this quality, we will be giving this amount as an incentive. They can assure you. When you come up to confirmation of 80%, 85%, you have completed the contract and you have satisfied the quality. Then the whatever you going to receive as incentive to be considered as revenue in this year. That has been said. The recognized revenue when entity satisfy the performance obligation, the entity recognizes revenue when it satisfies performance obligation by transferring the promised goods or promised service to the customer. So when you can recognize only after you transfer the goods, transfer the service, complete the contract on this portion, then after only you can do. Without transferring the rights and obligation to the user, you can't recognize revenue. The amount of revenue recognition, the amount allocated to satisfy performance obligation. Performance obligation can be satisfied in a point in time over and over time. So based upon the performance, based upon the services rendered, based on the completion process, the revenue should be recognized. And the entity transfer control of goods and control of service over time, therefore satisfy its performance obligation and recognize revenue over time. So only after the transfer of goods over the period of time we can recognize the revenue. Unless and until we transfer the goods, until the control has been transferred. Mostly the control is very important. Without the control transfer, we can do it. Control is been transferred. And we have been satisfied with the obligation. Then only we can recognize the revenue. This is one of the following criteria meet. The customer simultaneously receives and consumes the benefits provided by the entity's performance as entity's performance. So customer can receive the consideration at the same time the obligation has been completed, and it should be in the same panel. Entity's performance create enhances the asset that is customer control the assets and created and enhanced. So now what the asset has been created, it's been delivered to it. So by delivering to it, we have creating asset what amount receivable. Amount receivable it is asset for us right now. That's the thing. The entity performance does not create asset with alternative use of entity. The entity has a enforcing right to payment of performance completely. The entity performance does not create an asset with alternative to use the asset. To use the entity, and entity has enforceable right to payment for performance completed it. So not only we have done the service, we have transferred the right to them. We have completed as per the contract this much portion. When we have completed it, it is our right to receive payment. The entity has a right to receive the payment of completing the part, completing the obligation, completely transferring the right to or right to the user. So then you can account. They have the right to account it. The entity does not satisfy the performance obligation over time. The performance obligation is satisfied at a point of time. So, but when you can recognize the customer said, I am not satisfied with your service, then you can only account the revenue when the client is satisfied. Because there is no completion until the client is said, okay, it has been completed. For performance obligation satisfied over time, the entity recognize revenue over time by selecting appropriate method, output method and input method to measure the entity's progress towards complete satisfaction of performance obligation. We are saying one method that is what approach method, appropriate method. The appropriate method is both the input method and output method. By using this, selecting this method, the entity should recognize the revenue over time towards a comma what has been completed, what is a performance obligation. So I have obligation to do this. As per the obligation, I have completed this much. So by input and output of this appropriate method, we can recognize revenue. Frequent of contract cost. Ind AS 115 specify the following requirement of contract cost. So incremental cost in obligation of contract, cost to fulfill a contract. Two things you need to see. Instrumental cost to obtaining a contract. What is it? So to get a contract, you incur some cost. Then to fulfill the contract, you incur some cost. The two cost. Cost that the entity incur to obtain a contract with the customer that would not have incurred if the contract had not been obtained. To get the contract, you need to do some expenses. You need to give auditor report. You need to file some procedure forms. You need to get application money for getting the contract. You need to put designs, this kind of engineering cost, and this kind of contract. Entity shall recognize this cost as asset if the entity expect to recover this cost. Only if this cost is going to be recovered from it. So I'm putting this cost. I got the contract. I can get this contract. If I have assurance over it, I can put as a cost asset. If not, it should be expenses. Cost to obtain a contract that would have been incurred regardless of whether the contract was obtained shall be recognized as expense when incurred. So I'm completely putting in flow, sir. I don't know I will get or not. I will apply it right now. I will wait for it. If I don't get it, I no issue. If that is the mindset, that is expense. Unless the cost was explicitly chargeable to customer, agreed, regardless of whether the contract is obtained. Mm. So other than that, this is expense very good. Cost to fulfill the contract. Fulfill the contract is I got the contract. Then after I going to incur it. Example, I got a contract of designing a software. So then after I going to pay employees, pay any expenses regarding that designing, cloud computing, that kind of expenses to be cost of it. The costs incurred in fulfilling contract are not within the scope of another standard. Entity shall recognize as asset from the cost incurred to fulfill the contract only if such specific criteria are met. So for the contract, as per the contract, some criteria is there as per the contract, some expenses met, then it is an cost for the contract. If cost incurred to fulfill contracts are within the scope of another standard, entity shall account for this cost in accordance with other standard. In the kind of lease, in the case of other standards which I said, what are the things here? Lease. insurance contract, financial statements, consolidated financial statement, separate financial statement, investment in associates and joint venture, and non-monetary exchanges being entity in the same line of business. If in this cases that accounting standard will rule out. We can't say as per the construction contract revenue for contract we can't recognize. As per that standard, you should recognize that revenue. The contract cost recognized as asset shall be amortized as a systematic basis that is consistent with the transfer to customer of the goods or a service in which asset is related. Now, how what example? I have a contract to deliver delivering what um a tunnel. So, 1,000-meter tunnel I going to build it. So, based upon my obligation to build the tunnel, it is segmented into for every 25 meters of completing the tunnel, I can get a revenue of this. This 25-meter completion should be consisting of layering, this kind of protection. This is the final work to be considered. If it has been completed, that revenue should be recognized. So, what I put in the books of account party. So construction party account debit to contract 42, contract 52. So party account debit, I'm debiting it because I have incurred the cost over the contract. Now I can recover the money from the party. That's a way. The impairment loss shall be recognized at profit and loss to the extent this carrying amount of a contract cost recognized as asset excess the remaining amount of consideration the entity expects to receive in the exchange of goods or service in which assets related to reduction of cost that is relate directly to provide goods and service that is has not been recognized as expense. This may be there. Sometimes the contract cost will be 1 crore, but I have incurred 1 crore and 20,000 rupees. I have received total amount. The 20,000 is receivable in account. I can say receivable because my obligation is completed. They have settled the contract price. But I have incurred 20,000 rupees in excess. So that amount, what I to be, it is my loss. To be recognized in profit and loss account. Sometimes the actual contract value is 1 crore. Okay. The cost I incurred toward the contract is very only 35 lakhs. 35 lakhs. I got it. Totally 1 crore or 35 lakhs I incurred. Another 65 lakhs profit. I completed the contract. The contract is signed. Now 65 lakhs is profit. You need to book in the profit and loss account. Such a way, you need to you should see what is the impairment asset, what is it to be incurred, what is the cost incurred. That you should see. Presentation. When either party of the contract has performed, the entity shall present the contract and the balance sheet as an contract asset or a contract liability. How you going to show in the asset? I have a contract asset, contract liability you should show. Depending on relationship between the entity's performance and customer payment. I have received the payment in advance. Right? It is contract liability. I have to receive the money. I have done the work. It is contract asset. Entity shall present any unconditional rights to consideration separately as receivable. And if based upon without even sometimes software, uh, I have completed it, but I have to receive it. So it's an unconditional right to receive the payment, then you should have a receivable. That is what said in present in balance sheet. Sale with a right of return. Accounts of transfer of products with a right of return and same services that is provided subject to refund. Entity shall recognize all the following. Sometimes the company is there, but what happens is they have a contract, they have a completed 20%. Now they're thinking of we completing the contract, we can sell this contract to someone, transferable contract. The obligation is transferred to some person. He is saying I will complete it. So 20% what I complete, I'm receiving the consideration for that. And plus extra royalties or some kind of profit I'm getting. So this is what sale of right. So I should recognize profit. Revenue from transfer products and the amount of consideration to which entity expect to be entitled. Therefore, the revenue would not be recognized and product for a product expected to be returned. So, of what I entitled to complete the contract, entitled to get the revenue from that contract, I'm now transferring my entity to some one person, and I'm receiving some consideration. So, this is a revenue for me. Refund liability. Government has deducted the party has deducted TCS for the TDS for payment, making the payments, contractual liability, TDS payment. So TDS payment is a liability. So they had refund from liability. That should be component. As such, corresponding adjustment to cost of sales, a right to recover products from the customer on settling the refund liability. Sometimes they will say after completing the product, uh, your 25 percentage of security deposit only received after 6 months of our satisfaction. They will have some they will hold the money. So that kind of obligation is also that is also our customers are, that is also our revenue only. Sometimes that 25% may have a profit component. So that is to be considered. Warranties. If a customer has option to purchase warranty separately, a warranty is a distinct service because the entity promised to provide service to the customer in addition to the product that is functionally described in the contract. Example in Amazon, you can see, sir, if you want to buy this electronic item, that is cost 400 rupees. But we will give a 29 rupees warranty if any electronic deficiency or problem happen to this product for the next 1 year, we will refurbish the product or we will give you a refund or we will provide you free service. Such kind of warranty if the company is giving, that is an obligation for the company that you should account. In the case in the case, the entity shall account for promised warranty as performance obligation and allocate a portion of transaction price to performance obligation. So in this case, what happens? They have a performance obligation. If this is the incident happen, they are required to pay amount. That is linked with the warranty. So you need to you should not recognize a revenue. You should recognize liability in respect to this warranty. If the warranty cannot be purchased separately, an entity shall account for warranty in accordance with Ind AS 37 provision, conditions liability and conditions certain condition liability. So as per the provision of condition asset and condition liability in Ind AS 37, they need to account that. So they are saying principal versus agent consideration. When another party is involved in providing goods and service to consumer, the entity shall determine whether the nature of this promise is performance obligation to provide specified good or service itself, or to arrange the goods or service to be provided by the other party. Sometimes there will be agent. He will say, "So I will promise you, you will get this service in this date," like a broker or some more agent. So it's in this case, in this time, what will happen? What will happen? So, there will be liability as per Ind AS 37, provision for contingent asset and contingent liability. They have a contract. If that has not been delivered, will be penalized. If not been done, I will charge an interest amount of this much for every day, or this much penalty for every day for late delivery, or late quality has been delivered. I will not provide you this payment. I will provide you only this payment. That kind of agreement will be there. You should take into consideration if you are principal agent relationship. Principal versus agent consideration. The entity determines whether it is a principal agent or an agent for any of the specific goods and service promised to customer. It's been promised to customer, no, it is a principal or agent consider transaction. You should see through it. Indicate that the entity control the specific goods or specific service before it is transferred to the customer. But not limited to the following. But it should not be limited to this. What is this? The entity is primarily responsible for fulfilling the promise to provide specific goods and service. So entity is primarily responsible. They are getting the goods from someone, but the entity is processing and giving. And it is not the principal versus agent. The entity is an inventory risk before specific goods and service has been transferred to the customer or another transferred to control the customer. Example in this case, the customer client has asked for an AC unit. So, AC installation. What we doing? We are buying the AC and we are transferring it to customer's premises. We are not holding that. Our responsibility to fix the premises AC and establish. But before fixing it all, we transfer the goods and title to the customer. So now it is not a principal agent. A transaction is complete. Such a way we should see. To disclose sufficient information to enable user of financial statements to understand the nature, understand the amount, understand timing, understand the uncertainty of revenue, uncertainty of cash flow arising from contracts to customer. So, disclose sufficient all the information that is to respect to this user. You need to disclose what is the nature, timing, extent of content, who are going to do, what is the revenue, what is the cash we expecting, everything to be disclosed. Entity shall disclose qualitative and quantitative information. Its contract with the customer. What is this contract with the customer? A significant judgment, changes in judgment made in standards in applying its standards to the contract. So we have made this judgment as per this accounting standards in DAS. Accounting this policies we have followed. This is the competition India established that. Asset recognized from the cost to be obtained full in contract with the customer. So whatever the asset to be recognized and its cost to be fully recognized to be received by the customer. Have incurred this much, everything to be established. Service concession arrangement. Appendix D of Ind AS 115 gives guidance to accounting for operations for public to private service concession arrangement. So what is this? The appendix applies to both infrastructure that the operator constructs or acquire from third party for the purpose of service arrangement. So what is the infrastructure? That is the acquired or operator constructors from the third party for purpose of service sector. Then the existing infrastructure in which grantor use and operator access for purpose of service and management. Existing whoever gives us a service. The infrastructure within the scope of an appendix shall not be recognized as a property, plant, and equipment for operating between because the contractual service arrangement does not convey a right to control the use of public service infrastructure to operate. Sometimes what happened, I want to build this building, so I will get an contract from crane operator. I need 10 cranes. So you bring it and put it in my premises, and I will use it for next 3 years. After that only I will give to you. Now in this period I'm paying some rent or lease basis. I'm operation lease. I'm paying them. It's not a financial. It's operation lease. So I'm paying every month. And now the right and obligation. I can't charge depreciation. I can't charge expense rent because so substance I got or the material I got from for doing the service only for a period of time, and it is not a lease payment. You need to consider that. Transition. Entity may transaction in NDAs 115 using the two methods. Apply standards retrospectively with certain practical expedites and record the effect of applying the standards and a part of earliest probabilities have a comparative previous year. So the standard should be retrospectively, not prospectively, retrospectively should be there. Not only this, we should apply it to the earliest comparative period. Whatever the transition if it happen from the retrospective was whenever it start from that period it should be there. After applying the standard, open contract on the date of initial application and the record the effect of application applying the stands on the date. So what are the open contracts there? And what is the initial day of application? And the record, if what is the record of this effect of applying on this open contract? You should see the comparative period information is not restarted under this option. So it is not restating under this option with comparative period information. So you should understand that also. So these are the things you need to understand regarding NDAs 115. For transition, this is the purpose. For transition from a normal AS to NDAS. So retrospectively, should comes out open contract to be as per the comparable data as per this NDAS, not as per the gap and as per NDAS. No, everything should be as per NDAS. That is what being said here. So thank you. Bye. If you want anything to be taught, you can comment it. I will try to teach it. I'm doing my best and I'm improving every day. Thank you.